Welcome to the Real Estate Explainer podcast, where we talk about anything and everything real estate. I'm your host, Brian Kiczula. Welcome back to another episode of the Real Estate Explainer. Today we have Kevin Amolsch talking about alternative short-term funding options for real estate investors. Let's jump right into the episode. Hey, Kevin, just wanted to say thanks for being on the podcast. Lending is one of these things that I've got a love-hate relationship with. I was a lender for, it seems over 2 or 3 lifetimes. And I've stepped out of that world. And since I've left, there's been a ton of new loans that have entered the market. And your niche, specifically the alternative short-term financing deals, is just so cool. And it really opens up real estate investing to a ton of people.
Yeah, Brian, first of all, thank you so much for having me on the episode here today. I hope I could add some value to you and your listeners and viewers. So let me take you way back. So 2003, 2004, I was borrowing money from lenders to do rehab projects, fix and flips. It was interesting because it's like a construction loan, right? Because your money to acquire the property, then you have some funding available to you to do the construction for your rehab. And back then, it wasn't regulated at all. People could get in, get out. It's very easy. So I don't know how long ago you were in the lending space, but back then it was credit unions, surprisingly enough, that were providing the money for me. So I had a mortgage broker that had relationships with, call it 5 or 6 different credit unions, and they were funding these fix and flip loans. All of that basically went away in 2008. And then you had the SAFE Act and all of these things that came in, which started regulating lending in general, but even the private lending space. And so now if you want to get to this type of creative financing, you really have to go to the private sector. So we're private money lenders, all like hard money, non-bank financing, all pretty much comes from private money. And now they layer in some institutional capital, bank lines, and they're starting to sell them off onto Wall Street again. It's just now coming back. That's how it progressed.
Yeah, I got into lending back in 2002 and watching the transition over the years. And it just continues to evolve. And you're right, the credit unions were the primary lender. And I think there's still a lot of small community banks that are doing these type of transactions. But I guess they weren't private money lenders. I misspoke. They were the credit unions doing the deals. And now we've seen the private money lenders move in. And I know there's a lot of, let's just call it a negative, people think negatively when they're thinking about hard money loans. I don't really like to think of them that way, because it really is private money. And we're going to talk about this a little bit later. It's really using your debt provider or your lender as, think more of as a partner in the deal, especially if this is a space that you're going to be operating in for a long time, because they're going to help you fund deals over and over again. And if you can work with their system, then they are really a partner that deserves a relationship. So one of the things that I wanted to jump into, because there's a lot to cover, really is we're talking about short-term financing. So we're not talking about 30-year fixed mortgages. We're talking about typically interest-only loans, and we're talking about short-term deals. So I'm going to start with the shortest term deal that I saw that you guys offer on your website. And I know that, a lot of my clients in the cost segregation world, I work with real estate investors across the country, and I'm sure you work with quite a few of them. It's this flash cash loan specifically for wholesalers, guys that are doing wholesale transactions. And if you would briefly explain wholesale and then how this deal would work to benefit them.
Yeah, we don't see a whole lot of flash cash, Brian, right now, because I think investors have become more sophisticated over time. So I know that sounds pretty harsh to say it that way, but that's what I've seen. Let me explain what wholesaling is and how the transaction can go, and then why and when flash cash would come in. So wholesaling is when an investor that doesn't necessarily want to do a rehab, maybe they have too many projects on their plate, maybe they don't want to rehab properties, they're very good at finding them, they just want to make a little bit of money on just reselling them. So it's like the quick flip sort of business. You find a property discounted, you find an investor that wants to do the rehab, and you just sell the project as is to them, and you mark it up a little bit. So maybe you get a house under contract for $95,000. You could sell it for $100,000, maybe it's worth $160,000 after it's rehabbed, something like that. You just make that little $5,000.
And they're typically seeing that as an assignment fee, more or less, on the closing statement.
Yeah, so there's a couple ways to close it. So you alluded to the best and easiest way to do it. If you're able to get a seller to accept an offer that allows you to assign the contract to somebody else. So typically, if you're dealing with individual sellers, you could do this. Then you could just say, okay, I'm the wholesaler. As my buyer, I'm going to assign my contract to you for that $5,000. And then you step into my place and you close on the existing contract. So that would be the best way to close it. And that's one way to close a wholesale. Another way is to do like an assignment of an entity. And this is where I'm saying investors have gotten more sophisticated over time. So if you're going to a bank, for example, they don't want you to wholesale the property. They want to maximize what they can get for it. And if you can find a buyer for higher than what you're paying, they want to find that buyer, right? So they don't like the assignable contract, so they don't allow it. They won't sign that. So the way you do that is to put it into an entity. ABC LLC, for example, is the buyer on that contract. And then I assign my rights to the entity, not the contract. So I know I'm getting a little bit a higher level here.
No, this could be an entire podcast on assigning an entity, just because I imagine that maybe the individual, the wholesaler, whoever's finding the deal is retaining some portion of the entity until some time in the future where they drop off. So it turns over pretty quickly. So yeah, that could be a whole podcast. We'd probably spend an hour on it.
And what I love about real estate is you could be so creative, right? So we're getting into some of the higher level creative stuff that real estate investors do to be profitable. But this is a second way, and it's a great way to close wholesale transactions. So I'm just assigning my membership units for $5,000. Now you owned the LLC, and then you step in and you close in the name of that LLC. All right, so that's the second way to do it. The third way, and the less sophisticated way, is if you don't do either of those correctly, you don't set up your contract right on the front end, then you have to actually buy the house before you could resell it. You can't sell something you don't own, right? So then you have to buy it and then resell it. So we call that a double close. Typically, that can be done in one day, maybe 2 days. You close one day and then the next day you sell it to your buyer. In those cases, typically in most states, not all, but most, you're going to need to do what we call a wet funding. And that means you have to actually fund that transaction to buy it before you could resell it. So you have to wire the money into the title company. The next day when it closes with your buyer, you get your money back, right? So that's when you would bring in flash cash, someone like me that can come in and provide the money for the 1 day or 2 days or whatever you need to do it. It does cost you a point to do that. So it can get pretty expensive and eat into your profits. That's why we're just not seeing a lot of it.
Got it. Now, interesting loan. I'd never heard of it, especially the way it was listed as flash cash loan. And it's one of those things that personally, as a buyer on the transaction, it would probably put me on the brink of a heart attack, knowing that I'm relying on somebody else to help me close a deal right at the last minute. But it's interesting that you guys offer it. And then I've heard about IRA loans. I'm sure a lot of our listeners have funding deals through your IRA. And I definitely want to have you talk on this one just a little bit, because I know that I've seen it quite a bit. I've thought about it. There's a few reasons why I haven't done it on my own. But if you could talk about how those loans work.
Yeah, this would be interesting for you because I know you're into the tax strategies and you have lots of great relationships with CPAs and that type of thing. So this is probably something that would be fascinating to you and maybe your listeners as well. But when you have an IRA, as long as it's a self-directed account, there's some restrictions, but you can invest in anything you want. Now, you may go to a Charles Schwab or some other big brokerage house and they'll say you could direct your money however you want. They'll call that self-directed, but it's limited to mutual funds and bonds and whatever they offer. They don't offer a single family home down the street, or maybe you want to invest in somebody else's single family home and partner with them or loan them the money so they could do the fix and flip. So those are the types of alternative assets that can be done inside a self-directed account. You can also fix and flip inside of an IRA. The key here is that the IRS will not allow the owner of the IRA to guarantee the loan. So there's no personal guarantee on these loans, non-recourse, we call them. And that's important to understand because your IRA is protected under the IRS rules. So there's no recourse. Now, who's going to loan you the money and not have any recourse, no personal guarantee? That's where someone like us would come in and we understand the non-recourse. Our recourse would be the property itself, not you personally. So if you default on the loan, we'll just take the property and call it a day. We're not going to come after you personally.
Now, are these longer type of loans or are they still a shorter term?
Yeah, all we do is short term. Yeah. So this is where it gets interesting because you could fix and flip in an IRA and really start making a lot of profit in your IRA. If you have some funding in your IRA and maybe you don't have that outside your IRA to go do that fix and flip. But the key here is be sure to talk to your CPA because there might be tax consequence because it could be considered a business and you're flipping inventory. And when you sell inventory, there could be an unrelated business income tax. That's what they call it. So yes, you could still be subject to tax with fix and flipping in your IRA, but I do see people do it because that's where the cash is and it still grows.
Okay. So the key takeaway here is you would have to move your funds into a self-directed IRA. You're not using it for a long-term hold in this scenario. If you're using Pine Financial Group, you'd be fixing and flipping within the IRA. But prior to doing it, you'd want to talk to a real estate savvy CPA to make sure that you're dotting all your I's and crossing all your T's. So definitely a cool loan program. And I was thinking for some reason that you were doing it more long-term because I've seen those loans, but I haven't really thought about the fix and flip. And that's an interesting opportunity for a lot of people who have hundreds of thousands of dollars sitting in an IRA that want to get into real estate. So I think it's a really good option. The next one I wanted to talk about is the 90/90 loan.
Yeah. So our flagship loan is a 100% rehab loan. That's what we started with in 2008, and that's what we've been doing for the last 17 years. And in fact, I was doing that exact same loan before I started Pine Financial. But what I've learned is that some people are willing to put a little bit of money into the deal. Like they're willing to put some skin in the game if it's going to be beneficial for them. So maybe a faster closing. Is it saving some money on points or interest rate? So we've started offering the 90/90 loan, which is 90% of your purchase and 90% of all your construction. So if you combine those two, and we call that cost, you're going to be at a 90% loan to cost. And then we're able to save you a little bit of money on the origination and the interest rate. We also do just a 90% acquisition loan, which is cool because it's 90% of the purchase. You fund all of your construction yourself, and then we don't even need an appraisal on that one. So we're closing that loan in 2-3 days, potentially, if I can get all the documents that quickly, because I'm not waiting on anybody. We're just closing. So I know that's a little bit different than what you asked me. The 90/90 is 90% of purchase plus 90% of your construction and then a 90% acquisition.
I think most people plan on spending or bringing money in to a transaction. One of the things that is important, no matter what type of loan you get, whether it's a 90/90 loan or a 100% rehab loan, and that's going to be the next one that we cover, is reserves anyways. You're going to have some money in the bank because believe it or not, there is always going to be things that take a little bit longer than they should. They're going to cost a little bit more than they need to. And you're not always going to sell it for as much money as you want. So having the reserves is pretty much key. And we'll jump into underwriting in a minute. And I know I'm going through this pretty quick. And the reason why I am is because there's just a lot to unpack. So the 90/90 loan. So guys, if you are looking to buy an investment property, you can purchase the property with 10% down and 10% of the construction cost. So that is a very attractive offer if you're looking at continuing your real estate investments. But again, this is not going to be a long-term loan. You're going to have to either sell the property or plan on refinancing it down the road. Rehab loan, so 100% rehab loan. So rehab loan was going to be the next one, but I think this is what you alluded to, was it's basically a 100% deal.
Yeah. And that was our very first one. So 100% of cost, 100% of your purchase, 100% of your construction. We'll even roll the closing costs into the deal. So it's very high leverage. Now we cap that loan at 70% of the ARV after repaired value. So 70% ARV, and then we'll fund as much of that, your deal, as we possibly can into that. And that's super attractive for real estate investors because it increases capacity. We know that money is finite. We know that investors are willing to put money in at times. But sometimes they'd rather not, and they'd rather keep their money in their pocket, as you stated, to keep the reserves, because the money is much safer where they have access to it than if they're giving it into the deal. So the 100% has been a very successful loan for us. And then you even mentioned, I think just a minute ago, about the short-term nature of these deals. That doesn't mean that you're not building a rental portfolio necessarily. We have a lot of investors, almost half actually, it's quite a large number, buy property with these types of loans, 90/90 or the rehab, fix it up, get it tenant, get the income coming in, and then they refinance it with a Fannie or Freddie 30-year fixed rate loan. And why that strategy works so well is because it limits your down payment, and then you're buying cash flowing assets. So it's been coined by Bigger Pockets as the Burr strategy. So a lot of your listeners have probably heard of Burr, but the way that Burr came and where it started was hard money lending, funding 100% of the project, and then moving it quickly into a Fannie Mae loan.
I'd like to thank today's sponsor, Cost Seg RX, a cost segregation company. If you're interested in getting a cost segregation study, or if you'd like a free estimate of benefit, log on to realestateexplainer.com and click the cost segregation link at the top of the page. Now, when we're talking about short-term financing, when you're looking at a 90/90 loan or the rehab loan specifically, because things do tend to take longer than they should when you're looking at construction, and you can't blame it on everybody likes to blame the contractor, the plumber, the roofer, whatever. But the reality is they're busy. In most markets, quality tradespeople are busy working. And if you're doing this on an ongoing basis, you probably have a team of guys that you want to use on every project. If you can't get the slab fixed, you can't put in the tile, you can't put in the LVP, let's put everything behind. What are the terms? What are we really looking at as far as the timelines that you're giving investors when it comes to rehabbing these properties?
Yeah, I love what you're saying here, Brian, because I think that the construction piece is the most difficult to learn and manage in the fix and flip business. Everyone gets intimidated by the money. And I get it because you can't close without the money. I understand that. But the money's not so hard. The construction is difficult and managing contractors is difficult. So that's the skill that I would say newer investors should really hone in on and focus in on. And then to your point, once you get going and you start having some volume, you'll have crews that you could rely on. In the beginning, they're going to go to their fix and flipper that they've been working with for 10 years, and then they're going to put you off to the side and maybe try to work evenings and weekends or something, and you're going to get pushed to the side. So that does happen, and then it delays the project. To answer your question, our loan is 9 months long. Typically, we don't see extensions on that unless, like now, in a slower market, it's the houses get done, rehabbed, listed, and just not moving. In those cases, we'll have to do some extensions and that type of thing. But the construction, we're typically seeing investors, even new investors, there's delays, but we see them work through it because we're on them. Like, what's going on? Can we come out and look? We're doing our inspections in order to issue draws and that kind of thing.
Okay, that makes sense. So you're hands-on in these transactions. So there's a couple of points that brings up. Number one is, do you allow general contractors to do their own deals?
Yes.
Can they be their own general?
Yep.
Okay, so that is great because then you can really move things along if you're managing your own project. Number two is the 9-month extension. What is that? Then it's 1 month at a time and you're extending it out on a kind of a case-by-case scenario?
Yeah, and I've learned the hard way here. So I used to not put an extension into the documents at all. My thought was this is going to force a conversation. So when we hit the 9 months, you're in default. So now you're going to call me and we're going to talk and we're going to work it out. That doesn't happen. What ends up happening is people just expect you to just keep going forever. They think this is a 30-year loan. So now we have a built-in extension, and it's very expensive because I'm trying to get that phone call. So the built-in extension is 1 point per month, and the interest rate goes into 18%. So it makes it like, you better call me because we got to work this out. And then we're going to have a conversation, and then we'll typically do 3-month extensions at a time for a fee that's fair for both sides.
Okay, it's that first one that's going to put pressure on you to close the deal and get it turned over as quick as possible. That absolutely makes sense. So then the next one is, you had said that they're calling you. So in this case, they're actually having a conversation with you to move things forward. Is that accurate?
Yeah, our team. So yeah, we're small. We're 18 people based in Denver, just outside of Denver. But yeah, you're definitely going to get a hold of, and we answer our phone. So you're going to get a hold of a human being if it's business hours. And then you'll be talking to someone that can make decisions and help you.
Okay, perfect. So that's good. There's someone that you can actually talk to. And I wanted to say that's such a big takeaway with my business. I tell my team all the time, one of the things that is going to keep us going is personalized service. It's like you're not calling because you ordered something online or completed an application, and now you're stuck in this thing where you can never talk to the owner of the company or the individual that's making decisions. And that's what I tell clients. Call me, let's get on the phone, we can work through things. For me, it's better because it's just continued business in the future. So personalized service is huge. The next one was geographic location. You are based in Denver. Are you restricted to only lending in Colorado or Denver? What markets are you in?
Yeah, good question. There's two things here. So first of all, we've been talking this entire podcast about our borrower clients, which is great. And we are a little restrictive on the borrower clients because that's where we're placing our money, right? And our investors' money. So we have to be very careful with that money. That's how we've been in business for as long as we have, is we prioritize capital preservation. So we are lending in Denver and up and down the Front Range. We'll loan in the Twin Cities in Minnesota. That's where the majority of our investments are going, into those two markets. We also go over into Wisconsin, and then we've started doing deals in Washington, D.C. That's a whole funny story. I could share it with you if you'd like. But so D.C., Wisconsin, Twin Cities, and up and down the Front Range in Colorado. Now, on the other side, our investor clients, we have active investor clients, which is people borrowing money from us to do their projects, and we have passive investors that invest with us. And that's how we fund these deals. And we're taking passive investor clients from all across the nation. So we have pretty close to all 50 states covered at this point.
Okay.
I think there's a few that are a little quirky with their blue sky rules, but we have investors from pretty much across the country.
And I love that segue. That was perfect because when we talk about private money lending, you think, oh, it's my rich uncle who's actually providing this money. But now you've thrown it out there that, hey, you can be a real estate investor, use our loans to generate income. Or if you have cash sitting around and you want to put it to work, you could bring it on board and put it into projects as a passive. You're not a lender in that case, you're a passive investor. And I think that's so cool. So those doors are open as well. So if you love real estate, but you don't ever want to manage property, you don't want to have to do any rehabs, you could still get some decent returns by investing your money in these types of transactions. So that was a great segue. And I know I'm talking a lot during this, and I know it's just a ton to cover, and we could unpack more in maybe another podcast. But I also want to really dig into debt versus equity. And when you're looking at taking on debt, meaning private money lender or a traditional mortgage, versus looking at equity partner, maybe a friend or a family member, or setting up an LLC where you buy properties together, can you speak to the benefits of thinking of your lender as your partner in these deals?
Yeah. So I could tell several stories about this, but let me start with one. I have a very close friend of mine. He's from Croatia. He's a pretty prolific fix and flipper. He might do 5, 6 a month sort of thing. So he's very active. Now he likes borrowing from Pine Financial, and that's how I met him. But we require payments every month. And that was putting pressure on him because the amount, the volume he was doing. So he might write $100,000, $120,000 checks for all of these loans, right? A month. And so it was becoming a bit of a pressure point. And so he approached me and said, how about we take this outside of Pine? We're buddies. We've been doing business for over a decade. Why don't you just fund my deals with your personal cash, and then I'll share some of the profit with you. But in that way, I don't have to make these monthly payments. And as long as he's basically asking me, as long as you're okay with that, then this is what I would like to do. So I've started funding his deals outside of Pine Financial. There's just a couple of guys getting together doing real estate transactions. And he's given me between 40 and 50% of his deals. Now that's a very expensive partner to have. If he makes 60 grand, he's only keeping 30 of it, right? So that gets very expensive. I'm in another real estate group, really high level. So this is a $30,000 per year fee to be a member of this group. And you're allowed to do, they call it an op swap. You're allowed to get in front of the room and share deals, and people all get together and they do deals together. And the splits on some of these deals are between 30 and 50% for their private investors. And these are 7-figure deals. So again, very expensive. So I got up in front of the room and said, why don't we look at this a different way? Your guys are all bringing in equity, which means part owner, right? Your partner's part owner of your deal. They're not doing any of the work. They're passive, but they still own part of your deal. And you have to share in the upside. What if you bring in a partner that doesn't own part of the deal and they just put a lien on the property? You're basically borrowing money from them. It's just debt, right? It's just any mortgage. It's still basically a partner. Your money's coming in from another individual. But instead of half of your profit, you're giving away 15% on the note, a note rate or something like that. And then let's just do the math. And I went through 4 examples. Oh my gosh, Brian, the amount of business I got from that one presentation was way more than I could handle because I don't want to do that many larger types of deals. But just the concept for these very sophisticated investors to look at debt as partnerships instead of the equity as partnerships, and how much money they can keep by bringing in debt partners.
Yeah, why share your deal if you've got the cash? And I imagine in a lot of cases, we were talking about reserves a minute ago, a lot of folks do have the reserves to pay the monthly payments. So why not bring on a debt partner instead of an equity partner? And when you're looking at the short-term financing, don't let the interest rates scare you away. And I think that's what happens. You just mentioned, I think 15%, 18% earlier after that 9 months. And those numbers are terrifying when you're looking at like historic numbers when you're thinking about mortgages or 30-year mortgages. But that's not what we're talking about. We're talking about bringing on a partner to help you get the deal turnkey so you can sell it on your own and keep what you would otherwise give away in a partnership scenario. And that's not going to work for everybody. I know a lot of people like partnerships, just because it does spread across the risk and you have someone else putting skin in the game and bringing on their skill sets. And I think that's such a huge piece of it as well. When you're looking at doing these deals, is you want to make sure that, let's say all the key people are in place. So you know how to actually acquire the property, you know how to rehab it, and then you know how to list it, and then you know how to sell it, all within that 9-month period. So I think that maybe bringing on a partner that can assist if you don't have all the skills is a great way to move forward. But if you have all the skills and you can do the deal on your own, then having a debt partner, I think, is a great opportunity.
I 100% agree. Partnerships are super important and valuable if everyone's adding value. The problem is if you could find value, the same value for a lesser price, and sometimes that makes sense.
Absolutely. We're right about at the 30-minute mark. And I always like to ask, what didn't I ask you that I should have? And then how can folks get in touch with you if they're interested in either getting a loan from you because they're in the markets that you're doing business, or if they're looking at generating additional passive income by investing with Pine Financial Group?
Yeah, and whether it's Pine Financial or anybody else, look, there's a lot of question marks in the economy. There's a lot of volatility. If you get into real estate debt, that's going to be one of the most stable investments you could make because debt doesn't really go up and down in value. They pay an interest rate. Now, you will see that if you start getting into some defaults, right? But if you loaned $100,000 on a house, it's worth $150,000, and that value of the house drops because the economy gets wonky, and you go down to $130,000. That note is still $100,000. They still have to pay the $100,000, so your note value stayed the same, right? And that interest rate stayed the same. So I think it just adds stability to portfolios. I would never say put all of your money into real estate debt, but I think some real estate debt exposure is smart. And if you don't want to work with Pine Financial, I still think you should do it on your own. So I wrote a report that how do you do this and stay safe? How do you know that you're going to be in the senior position? How do you know the insurance is actually insuring the property correctly? Because there's policies out there that insurance agents that don't give you the coverage. And if the house burns down and your loan on it, you're not going to have any coverage. So you need to make sure you have the right pieces in place to keep your money safe. So I wrote that report. Your listener can get it for free at thepinereport.com. So I wanted to add that in there because I think the private debt space or credit is becoming very popular, and there's a reason for that. Other than thepinereport.com, the best way to reach out to us is just our website, pinefinancialgroup.com. I do answer my own emails. You probably won't get me on the phone if you call me, but if you email me, I do answer those. So it's kevin@pinefinancialgroup.com.
Perfect. Thank you for being on the podcast today.
Brian, thank you so much for having me.
If you've enjoyed today's episode, please leave us a 5-star review and click the subscribe button. It only takes 5 seconds, and it really helps us grow the show.